Here's today's Money Metals Minute, brought to you by MoneyMetals.com. Nervous investors sold most asset classes yesterday, erasing Monday's recovery. Precious metals and oil ended lower. The only traditional safe haven asset to gain has been the dollar. Gold is now closed lower for 5 days in a row. Now here's a special report from Mike Gleason of Money Metals Exchange.
It is my privilege now to welcome in Craig Hemke of the TF Metals Report. Craig runs one of the most highly respected and well-known blogs in the industry and has been covering the precious metals for close to a decade now and puts out some of the best analysis on banking schemes, the flaws of Keynesian economics, and evidence of manipulation in the gold and silver markets. We heard some talk coming out of the Jackson Hole Summit about how they were talking about both negative interest rates being a good thing for a lot of these central banks around the world. We're not doing it here yet, but it's maybe a good idea, and maybe you'd want to ban cash at the same time because you can't really do, negative interest rates effectively without doing that. And of course, that would be a fantastic environment for higher metal prices, you would have to think. Now, in today's markets, practically nothing matters except the guesswork around what a handful of central planners at the Fed might do with interest rates. It's pretty sad to say that almost nothing else seems to move prices. And it isn't just the metals markets that are obsessed with monetary policy. Bond markets, currency markets, equities, all of them are hanging on just about every word Janet Yellen and her comrades are saying. Now, most Americans have no idea just how managed our markets have become, but you have to think, Craig, that a day of a reckoning for all of this intervention is approaching. Talk about how you expect this to end and what some of the signals might be that the system as we know it is starting to unravel.
You're right. The markets are really, frankly, a sham at this point, and there's multiple reasons why. Every muttering of a Fed governor or somebody from the ECB or the Bank of Japan, the reason why that matters is because these markets that I call a sham are all now nothing but computers trading things back and forth. I mean, there's very little human input. When I first became a stockbroker 26 years ago, there was actually people buying mutual funds and buying 200 shares of Coca-Cola because the fundamentals look strong, that kind of thing. But now 80 to almost 90% of the volume on the New York Stock Exchange is just these high-frequency trading computers swapping things back and forth at light speed, clipping each other for fractions of a penny. I mean, it's just a massive scam. And so the Fed knows this. And so if they want to pump up their stock market, which is obviously one of their key indicators, and everybody from Yellen back to Greenspan has talked about the wealth effect, about having people feel real good about themselves and go buy a new refrigerator because their 401k is going up. So if they want to pump up the stock market, they know they can do that simply by getting these high-frequency trading machines to do what they want them to do. The argument against federal or central bank stock market intervention manipulation is, you can't do that. It would take trillions and trillions of dollars. Either that's a very naive statement for someone to make, or they're simply trying to mislead people and carrying the water for the central banks. Central banks can easily manipulate the stock markets just simply by manipulating the inputs of these high-frequency trading machines and getting them to either buy or sell whatever market that they want to see move. In the particular case of the stock market, it is clear for anybody that wants to pull up the charts that these trading algos, these high-frequency trading machines that buy index futures on the stock market and move it up or down, are one of the clear things they follow is the dollar-yen, the relationship between the U.S. dollar and the yen. So if you want to, if you're Janet Yellen or one of her goons, and you want to see the stock market go higher, then all you have to do is jawbone your way into talking up the dollar to weaken the yen. That's all it takes, and then the machines do the rest. That's why we've seen so many V-shaped recoveries in the stock market over the last 2 years. I mean, just as soon as it's looking like it's going to go all to hell, all of a sudden, boing, and it bounces straight back up. Well, that's the Fed saying something to get the machines to do what they want them to do. So at the end of the day, your question is, how do you know when it begins to fall apart? I would say when we begin to see a breakage of the machines not doing what the Fed or the ECB or the Bank of Japan wants them to do. If all of a sudden interest rates are spiking, that would be, wait a second, they don't want interest rates to spike. That would be something. If all of a sudden you see the stock market really beginning to move down against the long-term trend of what's been happening in the yen, that would be something. You really have to monitor those internal things for signs of, I guess, the system breaking. Certainly not seeing it yet, and I mean, that may not happen for a while. They've kept the plate spinning for 6 years. Maybe they can keep them going for 6 more. In the meantime, I'm just perfectly content stacking my physical gold and silver, because I know in the end, the uneconomic systems that are just a sham and illusion like this, they just can't go on forever. And we'll patiently wait for that end to come.
That was Craig Hemke and Mike Gleason at moneymetals.com. Live prices at moneymetals.com show gold currently trading at $1,322.20 per ounce. Silver comes in at $18.97.